Welcome to Financials 101, a four-part video series designed to give you a foundational understanding of the three main financial reports every small business owner should use and understand. This video covers the balance sheet. I'll explain how this report is structured, where the numbers come from, and why this report is useful. Let's get started. I'll begin with this simple statement. Every financial activity of a business creates an asset or a liability. This statement is the basis of all three financial reports. In this video, we'll focus on tracking assets and liabilities using the balance sheet. The balance sheet is a snapshot of the overall financial health of the business at a given point in time. I say snapshot because by virtue of that statement above, every financial activity, the moment a financial activity happens, it changes the assets and liabilities. When you buy inventory, it changes assets and liabilities. When you sell inventory, when you sell something, it changes assets and liabilities. If you take on a loan or pay off a loan, it changes the assets and liability. Because any financial activity changes an asset and liability, the best that we can hope for is a snapshot at a given point of time. And for this to be useful, we usually take the snapshot of the business at the same time throughout the year, typically at the end of the month, end of the quarter, and the end of the year so that we can compare. So what does a balance sheet show? Well, as I mentioned, it shows the overall financial health of the business in kind of an overview sense. It can give you an idea of, can the business handle the normal ebbs and flows of revenues and expenses? Are there enough cash reserves to handle emergencies, or is the business in a position to expand? It can answer, are customers taking longer to pay, and therefore should receivables, that's what customers owe you, accounts receivable, should they be collected more aggressively? And does the business owe more than it should relative to income? Is it beginning to drown in debt, as the saying goes? Should the business sell off some assets to pay down this debt? So looking at the balance sheet can actually reveal quite a bit about the financial health of a business. Let's take a look at how a balance sheet is structured. I'm going to draw a parallel between the personal side and a business. For any of you that have applied for a loan, you've already gone through and built a personal balance sheet. So I'll start there. On the personal side, what you own in a business, what a business owns is called an asset. The personal side, what you owe, what the business owes is called a liability. If you were to if you were to sell everything you own and pay off everything you owe, what's left over is called your personal net worth. In a business, if it were to sell all the assets in order to pay off all its liabilities, what's left is called equity. The type of equity depends on the legal structure of your business, but it's basically what's left over. That's what you, as the owner of the business, may be entitled to if it were to sell off all its assets in order to pay all its liabilities. Specifically, let's look at how a balance sheet actually looks. As you've learned from other videos, we have a friend Sarah who opened a bakery, a pie bakery a little while ago, and she's agreed to share her at least one of her balance sheets. This was taken on May 31st of this year. You'll notice that there's a left side and a right side. On the left side, we have assets. On the right side are liabilities and equity. At the bottom of the page, you see what's called an accountant's equation. This is where assets equals liabilities and equity. Both sides have to be equal. They have to equal each other. They have to be in balance, hence the name balance sheet. So let's look at how it looks for Sarah's Sweetie Pie's Bakery. Assets are divided into two broad categories. The first category is called current assets. These are assets that can be turned into cash relatively quickly. We see that as of May 31st, Sarah's business has in her business and savings checking accounts a total of $2,500. Well, that's already cash. It doesn't need to be converted. We also see that she has some accounts receivable. This is where she has delivered pies to a customer, has sold pies to a customer, but they haven't gotten around to paying her yet. In this case, it applies to a corporate event that she did. She's given that corporation 30 days to pay, and May 31st is within that 30 days, so the corporation hasn't paid yet. But it's what's legally owed to Sarah. She's done the work, and the contract says they owe $400. She also has some inventory on hand. That inventory she's broken down into raw materials, her raw ingredients, any pies she has in process, and any finished pies that are waiting to be sold in the display case. She looks at the wholesale cost or the cost of producing those, and that comes to $2,500. When she adds up all the current assets, total current assets equal $5,400. The second general category that assets are divided into are called fixed assets. These are assets that cannot be converted into cash relatively quickly. Now, in her case, her business doesn't actually own any buildings and land. In your case, your business may, but in her case, she rents the space. And so that's a zero value there. However, she does have some equipment. And last year, she bought $15,000 worth of equipment to help improve her business operations and make pies a little more efficiently, as well as keep up with demand. And the IRS says that that piece of equipment, you can depreciate $1,000 every year, let's say. And so we're, let's say, a year into the use of that equipment, the depreciation is therefore $1,000. If we add up total fixed assets, that comes to $14,000. If we add current assets plus fixed assets, you see for Sarah, as of May 31st, her business has total assets of $19,400. The question is, does that equal the right side, the liabilities plus equity? Let's find out. Liabilities are divided into two categories as well. The first category is called current liabilities. These are liabilities, what the business owes, that can be paid off in a year or less. As of May 31st, her business credit card shows a balance of $1,200. She has an accounts payable. That's what she owes some other business. In this case, it's $100 due to a utility. She got the bill on May 30th, has entered that into her accounting software, and it shows that she owes that utility $100. She has a couple weeks to pay that, no worries, but it's on the books as $100. She also has an employee which she pays every 2 weeks. As of May 31st, she's halfway through that pay period and owes that employee $300. Hasn't actually paid them yet because it's not the end of the pay period, but she does legally owe that person a wage. If we add up current liabilities, we see it comes to $1,600. The second category for liabilities are liabilities that cannot be paid off in a year or less, and typically these are real estate loans or loans in general. And here you can see Sarah took out an SBA loan for which she still owes $10,000 as of May 31st, and she has a loan from her Uncle Bob, which she hasn't begun to pay back yet. He's okay with that, for $1,500. If we add up long-term liabilities and add those to the current liabilities, we see a total liability of $13,100. Equity is made up of different things. Equity consists of the opening balance. That's the money that she put in to open her business checking account. She took $1,000 of her own money and put it into the business to open the checking account with $1,000. This happened a few years ago. Her owner investment, that means that somewhere between when she started the business and May 31st of this year, she had to kick in $500 of her own money just to cover bills or so. It's the only time she's had to do it, but it's listed there. Retained earnings is money generated, it's the profit from the business generated but hasn't been distributed out as dividends or owner draw or anything else at this time, May 31st. She may take that as an owner draw later, but as of May 31st, that money is still in the business. It's kind of left over from the profit, if you will, comes out of the profit. So if we add up the equity, total equity there, we see it comes to $6,300. If we add liabilities plus equity, we find the total is $19,400. It does indeed equal the left side of the balance sheet. They are in balance, and hence the name balance sheet. Now that we understand how a balance sheet is constructed, Let's take a closer look at how they can be used. If Sarah's thinking about expanding her business, she could look at the cash line there and determine, is there enough money in the bank to fund that expansion? Or let's say she's buying a new piece of equipment. Does she have enough money to do that? In the accounts receivable, if that number is increasing, is it because she's selling more to corporate clients or customers that she's giving time to pay? Or is it because existing customers are simply taking longer to pay? And inventory, is she turning inventory quickly enough? Is inventory building and sales are not? Is that number increasing? That's not a good thing. Fortunately, there's a way to look at a balance sheet more quantitatively, and that's through the use of financial ratios. The idea here is what gets measured gets managed. If you can see changes quantitatively happening, you can take corrective action if you need to. A common measure is a current ratio, and as you can see, this is current assets divided by current liabilities. It's a measure of credit worthiness. Every lender will look at that current ratio, and it tells that person for every dollar in liabilities, how many dollars in assets can go to pay off that debt. So if you recall, current assets are assets that can be turned into cash fairly quickly. And current liabilities are liabilities that can be paid off fairly quickly. This is a measure of how quickly a company can pay its debts if it had to. Very useful. For those of you that have inventory, it would be good to know how many times a year does your inventory turn. The idea here is you want to have your inventory turn as quickly as possible. The faster your inventory can turn, the faster you can sell it, in other words, the more money the business will make. You can determine this by taking the cost of goods sold for the year and divide that by the average inventory you have on hand typically. And this will tell you how many times a year that inventory turns. Conversely, well, once you have that number, you can then go a step further and find out how many days stuff stays in inventory on average. The idea is that you want this thing to be as short as possible. There's an adage in retail, or for those of us that have inventory, if it doesn't turn, it doesn't stay. If it's sitting on your shelf, that's your money sitting on the shelf, and it's not doing anything until you can sell it. If it's not selling, get rid of it. Blow it out in a sale or do something. If it doesn't turn, it doesn't stay. You want to turn inventory as quickly as possible. For those of you that have inventory or not, even if you have a pure service business, but you have accounts receivable, you're giving people time to pay, it would be good to know how often does that turn over. Again, you want that to be very quickly. You want people to pay, well, when your credit policy says they should. If you give them 10 days, they should pay in 10 days or less. Same 30 days, 30 days or less. Accounts receivable turnover will calculate how many times per year your accounts receivable is turning over. And you can apply that in the next equation down to determine the actual collection period. In other words, how long your customers are actually taking to pay what's owed the company. If you give your customers 10 days and they're taking 15 or 20, well, compare that to your credit policy. Are you okay with that? If not, then ask yourself, is there a way to speed up collections? Is there a way to collect these receivables more aggressively? So balance sheets are indeed useful, especially when these ratios are applied. But I'll leave you with something Henry Ford noticed. Not everything is on the balance sheet. This video is made possible by funding from the Pacific County Economic Development Council. I'm Jim Williams, a trainer and business coach with Enterprise for Equity. Our mission is to help people with limited income start and grow their own successful business. For more information about our classes, please contact us.